Charles Henry Monchau. He is Chief Investment Officer at Bank SYZ, which is a family-owned Swiss banking group with more than $41 billion in assets. Charles Henry, thank you very much for your time today. We appreciate it. I guess as you've watched everything unfold over the last 24 hours, what's been going through your mind?
Well, there are some good news and bad news. I think the good news is that Credit Suisse systemic risk bank seems to be rescued. The other good news is that, like in the US, it was possible for Swiss authorities to meet, over weekends and then find a solution. And the other good news is that Switzerland will now have a giant with more than $5 trillion in assets. The negative news is, as you mentioned, in terms of reputation, I think the Coco story, AT1 story, is quite a shock for the markets this morning. We all suppose that these AT1 were senior to equities. It doesn't seem to be the case. And obviously also for UBS, now the hard part is starting because, if you look at the assets of Credit Suisse, there are roughly $570 billion, which could be somewhat at risk of being impaired. So with $3 billion purchase price, that looks, like a bargain, but obviously there are a lot of risk attached to this deal.
You did reference a type of bond, which a lot of people are mentioning. I will say it's not a commonly discussed asset, or at least classification of an asset. Why has it been getting so much attention?
Well, it was after the the great financial crisis, it was the perfect asset. Why is that? Because these type of bonds help European banks to strengthen their capital buffer, point number one. And point number two, they were paying quite hefty yields. So at a time of zero interest rate policy or negative interest policy, having bonds with a high carry were very interesting. So many investors jumped into these bonds. And obviously, the rules expected were that these bonds would be senior to equities. And I think that's where the shock is this morning, is that we see that, with the Credit Suisse deal, actually, stockholders are getting something, not much, but they are getting 76 cents. But the Tier 81 Coco bondholders are not getting anything. And we saw this morning in Asia, where you can find some 81 bonds as well, that there were a lot of pressure with the 81 bonds being down between 5 and 10%.
Helpful context there. And I guess at the end of the day, what we were talking about is, well, people want to highlight governments in different countries at this point, which are influential behind the scenes in making deals happen to avoid collapses. Wipeouts for investors are a potential reality whenever we're talking about businesses going under. We talked about, obviously, in the United States, the situation with banks there and equity investors getting wiped out. And you're highlighting essentially what some bondholders thought would not be a scenario unfolding, but is unfolding for them. And, we could talk all day about moral hazard and the complications with each new crisis situation that unfolds right now. But I referenced the U.S., where we're getting a quick learning lesson in what certain banks were all about, such as Silicon Valley Bank. Credit Suisse, at least in terms of name and reputation, nobody needs a learning lesson. What are your reflections, given that this bank has been around for more than 165 years? It's clearly gone through turmoil for a very long period of time. But the fact that this deal is coming together so quickly, and we haven't even had a chance to really think about the fact that this institution is in many ways no longer.
Well, you said that it is happening quickly. Actually, it has been a very long agony. If you look at the story of this company and the stock, it has been years of, let's say, issues, scandals, and bad results, which is indeed a pity. But again, I think that the priority for the Swiss authorities was to save a systemic bank with huge exposure to derivatives. So it was not just about, let's say, one single name. It was about the Swiss financial place reputation, and also, let's say, the global financial system, because we know that all of these, let's say, banks are intertwined. So it's a very different case than SVB, obviously. It's a systemic bank. And now the question is that we are moving from too big to fail to potentially too big to save. And that was maybe one of the reasons why UBS-Credit Suisse didn't happen before, because Switzerland was not very keen on having just one giant, instead of two giants.